Hey everybody, this is Brant from Wolf on Wall Street Trade with the market update for the week ending June 19th, 2020. This is the S&P 500 as it looked as of last weekend's video. And I'm just going to do a quick recap of where we were last week. Let me pull up the Dow real quick. And this is a daily chart of the Dow. Let me zoom in a little bit. Into the first week of June, we saw this reflation trade. Now, that's been the narrative for this whole rally, that the United States is reopening, the world is reopening, and we're going to have a V-shaped recovery. But this was the first time that it really looked like it had some conviction, and the bond market was also signaling the same. You might remember we got the Payrolls report, which was a blowout on the headline basis, but then once you read the actual data, it seems like they may have misclassified over 4 million people on that report, and the unemployment rate was much higher. In any case, last week we saw a complete reversal of that theme. Here's the theme over here above the 200-day moving average last week, a complete reversal of it. The S&P was down almost 5% on the week. It was the worst week since the crash over here, so it was a really big event. So this is what the S&P 500 looked like as we ended last week when I did the video. Here's a little recap from last weekend's video as to what I expected going forward into this past week. I'm leaning towards a consolidation in the first part of next week, and if so, then it might look something like this. But right now we do have some pretty serious support levels, whether it be the 200-day moving averages for some of the major indices or areas like this for some of the cyclical sectors. So we shall see, but this gap is really one of the important areas to keep an eye on, this island. Okay, so the bottom line was we had a very oversold market in a really sharp drop, but a lot of S&P sectors and a lot of the major averages at some important support levels coming into this past week, where Jerome Powell was also testifying before Congress. So it seemed like a reasonable thing to expect a little bit of correction, consolidation, working off this deep oversold condition. So if we walk the S&P forward, that's pretty much what we got this week. But it was a little bit sharper. So Monday we opened up real ugly. Sunday was very ugly. But in the futures, index futures were down sharply, but the bond market and the currency markets weren't really on board. So it didn't look like it was really a convicted next leg sell-off. And the market really just reversed into the cash open. And then on Monday, the Federal Reserve, just one day before Jerome Powell starts testifying before Congress, they come out and say that they're going to buy corporate bonds, which we already knew, but they reiterated it, and the market flew up. So my target for my members early in the week was, I said I thought we would hit 3130 for the S&P 500. So we hit 3130, which is about right there, very early in the week. And you can see the rest of the week we just went sideways. This week was the biggest quad witching options expiration of the year so far. So I also thought, maybe we're going to see a price pin, and it seemed like that as of Tuesday, Wednesday, Thursday, as we got into the week. It just seemed like prices were being pinned between 3,100 and 3,150, and that's kind of how we ended the week. But I kind of expected more of a bearish flag, like what Dow Transports looked like. So that's to say something like this. And by the way, Dow Transports ended the week 0% unchanged for the week. So they did correct, worked off that oversold condition from breaking this trend, but were unchanged on the week. That's kind of what I expected for the broader averages, but they were a little bit stronger because of that Fed news early in the week. The S&P was up 1.9% on the week, so this little price action here, and here is that ascending or rising wedge that was broken. So this was kind of what I was looking for. We had an island top here, did not fill that island top gap. This is pretty much what I was looking for, up to 3130, but just in a little different fashion getting there. Looking at the S&P's daily chart, this is Friday. We did close with a bearish engulfing candle on Friday. As far as the corrective activity, so we look at volume. We see volume picked up on the sell-off, and then on this past week's correction decline. So that's also indicative of just a correction consolidation. Here's the NASDAQ 100 30-minute chart. So it back tested into this rising wedge. Did virtually the same thing over here. This is a much smaller wedge. Did it in basically almost the same fashion. Let me kind of go back to this area. So initially traded a little bit above the wedge, broke down below, back tested it, and then carried on lower. That's the small wedge in early May. And that's the exact same thing we see here. Up above it a little bit, breaks down, and back tests into it. Interestingly, on this daily chart of the NASDAQ composite, same exact thing, except you have a much bigger wedge. I say this all the time. You kind of get this micro and macro kind of smaller patterns inside of larger ones. prices reflect human nature, and that's why these patterns have been with us for hundreds of years, and they work over and over and over again. So you're seeing the same thing on a smaller, shorter term basis as we're seeing on this longer term basis. So here's a big wedge on the daily chart, a break below, and a back test of the wedge. Same exact thing that we're seeing on this 60-minute chart of the NASDAQ 100. And the NASDAQ was the best performing, by the way, up 3.6% on the week, which is a slightly more defensive rotation. I know it doesn't sound like it, but it is. I'll get to that in a minute. So here's the Dow 30. I showed this pattern last week, a broadening formation. We talked about that earlier. The island top, here's that reversal we saw last week, back test into that broadening formation. Speaking of the micro, macro technical picture, this is a daily chart, actually a 2-day chart of the Dow. This is 2018. This is a big broadening pattern. Same thing, played out the exact same way as the small one we're seeing here. Initially traded a little bit above on Fed liquidity and broke back below. So back to the Dow 60-minute chart, same thing, a little bit above, broke down, back tested into that same exact broadening wedge. This is a chaotic pattern that suggests that the market is losing intelligent sponsorship and it's getting more chaotic, bigger swings up, bigger swings down. And on a daily chart, here's the island top, so it did not fill that gap. This is the Dow daily chart, and it closed under the 200-day for the week, and also bearish engulfing candle here on Friday. The Dow was the worst performer, up only 1% on the week, so relative weakness from the Dow. Dow transports, which tend to lead the Dow, were worse. They were 0% on the week. And here you can see them. They did not test up as far as that 200-day, and also a bearish engulfing candle over here on Friday. In fact, here's the broadest index, the NYSE. Same deal. This is kind of the reflationary trade, the payrolls data, that kind of rotation that I was talking about last week, and the sharp turn of that rotation. So this is how it ended Friday. Again, another bearish engulfing candle for the NYSE. So the case I was making last week was an oversold correction because we had a lot of support areas in the neighborhood, and the market was very, very oversold in just like a day or two. But what I was watching was, did we see any reversal of that reflation, deflation kind of bias in the market? The answer is no, and we can see that through S&P sector performance on the week. So back here, it was the sectors, the value sectors that hadn't performed very well, that are cyclical, so they need the economy to grow to do well. That includes materials, energy, financials, industrials, banks, stuff like that. The casinos, the cruise lines, the airlines all fell into that category, and they saw some of the more speculative trade. So did we see a change of that? Those all got hammered the prior week. No, there's no change. Here's a 15-minute chart of the energy sector. This is why I said, we had a lot of support areas around here, so I thought we would correct. We did this week. So the worst performing sectors, or the laggards on the week, were the cyclicals. So energy, materials, financials, industrials, the Dow transport, same thing. And you can see they really just didn't do anything. Almost look a little bit more like the bearish flag that we saw in transports, which you can see right here, as opposed to the S&P 500, which ended the week with more of a small bullish flag. Interesting. So back to energy. Again, these cyclical sectors that really did well here and then got slammed the prior week did not do very well this week. The ones that did better were the secular growers. So technology, the communication sector, these are the ones that have the mega caps, the FANGs, like Facebook, Amazon, Apple, Microsoft, Google. Here's the tech sector. It was one of the best performing, 2.85% on the week. You might remember last week in the video I said just barely broke down, so got back above this, holding this trend line from the March lows. Here's the communication sector, also one of the top performing sectors on the week, more defensive than those cyclical sectors, but not a risk-off move, obviously. So this is a big rising wedge. It broke below that the prior week. So although it did outperform, it just back tested that wedge, so it did not recapture that trend line. Was not technically significant. The technology sector was. So back to the 30-minute chart of the S&P 500. Like I said, it ended a little bit like a bullish flag at the end of the week. Did not fill this island gap over here, so that's still wide open. So this was one of the things I was looking at the end of the week. Is this a bullish flag where it suggests we get another move up, maybe up to about 32.50 or so, or is it just that we hit this kind of options expiration pin between 3100 and 3150? That's kind of what it seemed like to me. So this has like a little bit more of a bullish look at the end of the week, even though we ended with a bearish engulfing candle. Whereas the transports looked a lot more like what I expected last week. The breakdown, a consolidation in a bearish flag. The financial sector looks a little bit more like this. Energy looks a little bit more like this. So had those cyclical sectors outperformed on the week, I would have given the nod to the S&P with a little bit more bullish outlook in the very, very near term, but they underperformed. So we can look at a few other things like the bond market. Here's the 10-year yield daily chart, and I'm going to zoom in a little bit. I'm going to go to a 60-minute chart. So here's that kind of reflationary signal, and here is the reversal of it. So this week, over here, this correction, this left the 10-year yield completely unchanged on the week. So just a correction consolidation, nothing more. So it leans towards, that's all we saw, a correction consolidation in the broader market. What I showed in last weekend's video was that certain assets like the bond market and currencies led the market lower. They were showing this big rotation, started here, ended over here. So here we are this week. Again, just a typical consolidation. It looks a lot more like the transports than it does any kind of bullish flag. And there's the transports, by the way, with the 5-year yield here in blue. Here is USD JPY, the dollar Japanese yen. Last week I said it led the market lower into that sell-off. So here's the correction this week. Again, it's just a correction. In fact, this currency pair was down 0.5% on the week. So it was not going risk on. It was just consolidating through time, working off this really sharp, steep, quick oversold condition. And to add a little bit more context, this is S&P futures here, and this is a 30-minute chart in the candlesticks, and this is USD JPY in purple. So like I said, led the market lower, led the stock market lower. Here is the correction consolidation this week. We have the currency pair still leading the S&P lower, just consolidated over this past week off this oversold condition. I was looking to add some positions. I closed one short coming into this week, took a profit on that, and I left 4 open. By the way, 3 of the 4 shorts that I have on still actually went up this week. They made more money. The stocks that I shorted went down. But what I was getting at was I was looking for a signal. So right now I feel pretty strongly that this is just a consolidation correction of this oversold condition. I was looking for a signal, whether that come from the currency market or the bond market. But what seemed pretty clear to me was that we were just seeing prices being pinned into that quad witching options expiration around 3,100 to 3,150 for the S&P 500. As for the VIX, down about 2.5% on this week. But one of the big things, this is the crash sell-off. VIX was exploding higher. This is as the market has rallied, VIX has pulled back in this channel. This is last week breaking out. So VIX was up almost 50% in one day. Huge, huge change, huge trend change. So this is this week. We have a little consolidation that looks like a little bull flag. VIX is still projecting more volatility to come. This is a bearish pattern for stocks and a bullish pattern for volatility. Notice on the daily chart here, VIX, here's the pullback, here's that last week's breakout, and this is the 50-day moving average in yellow. Notice it held that 50-day moving average this week. So this is one of the things I was saying last week, that this seems like a very important trend change, a regime change in volatility, from the market correcting, doing its thing, rallying, to all of a sudden volatility breaking trend and moving higher. So if we look at the S&P 500 real quick, here's the trend off March's low. So the same time VIX broke out of its channel, the S&P broke down below this. Now we've seen other channels or other trend lines like over here break, and then the market went sideways and up more. So it doesn't necessarily mean, everything's going to fall apart, but this is the first time that volatility has also broken out. Volatility kind of tends to act the opposite of the S&P 500. So while the S&P 500 broke this trend, VIX over here for the first time broke out and broke above this trend. So it does seem like a more meaningful break in that S&P 500 trend just because of what volatility did. So what do I think this really fast change in underlying dynamics is all about, going from like the bond market and the stock market looking forward to a reflationary environment to suddenly changing at that payrolls report? I think it's about rising coronavirus infections. I've mentioned this in the past couple of videos. I'm no expert in epidemiology or anything like that, but this is, new cases in Florida, which is where I live. This is why I'm just bringing this up. I'm not talking about other states because I don't live there. But this is before the United States shut down. This is as the United States shut down. This is where Florida started to reopen on May 4th. And like I said, I can read a chart, and this trend is basically going almost parabolic at this point. So this is new cases. It's not deaths. It's not hospitalizations. I know, there's different things we can look at. I think usually the deaths follow with about a 2 or 3 week lag. In the meantime, there's other states that are picking up as well. And perhaps that's starting to reflect here on the overall U.S. New cases. So trouble in Beijing, China as well. they're seeing an uptick, so they've canceled flights, they've closed all schools, they've cordoned off some neighborhoods. So we're seeing what may be a second wave over there. In the US, it seems like we never really got through with the first wave. Apple this week started closing some stores in states that have a uptick, including my state here, Florida. Cruise lines have voluntarily extended their shutdown until September 15th. It doesn't really matter what the federal government says or does. It matters what local governments do, it matters what businesses do, and ultimately it matters the most what consumers do. And in the meantime, the V-shaped recovery narrative got hit pretty hard this week with initial claims coming in much higher than expected at 1.5 million with an expectation of 1.3 million. Just for some context, because they are going down as you'd expect, before all of this started, the highest 1 week print was 695,000. Okay, so this past week we had 1.5 million new initial jobless claims. So this is one of the things I've been saying is that the stock market has rallied. It has priced in a complete V-shaped recovery and more. It's trading at the most expensive valuations, at least since the dot-com bubble. And one of the things I've been saying this whole time is that if that were so, you'd expect the bond market to reflect it. And the bond market has just been consolidating. This is why that 1 week was kind of impressive, because the bond market started to break out, started to confirm, and then completely reversed and retraced. But let me show you what a V-shaped bottom, a recovery, looks like when the bond market confirms. So this is the SP 500, this is the 10-year yield, this is the financial crisis over here, the bear market. By the time we get to the March bottom over here, yields were making higher lows 2 months before the market bottomed. Look at the 10-year yield. It is making higher lows over here before the market, and it's leading higher over here. So what does it look like now? Well, it's certainly not leading the S&P 500 higher, is it? A couple things I'm watching are what currencies do and what the bond market does. Here's the 10-year yield. It looks just the same as it did when it was leading the market lower over here. Consolidated bearishly into Q3, Q4 of 2019, broke down into 2020, led the market lower, and it's been doing the same thing just like it did over here. So what I would be looking at over here, let's zoom in, would be a break of this trend under 0.67 or 0.65. It's not very far away. This could happen in a blink of an eye. Look how much it moved the week before. These are some of the signals that I'm talking about that I'm watching for to up my exposure in shorts, although I have a pretty good exposure on right now. From a much bigger picture perspective, this has been an incredible rally off of this sell-off low. But, we see these rallies getting bigger and these sell-offs getting bigger as we have this big broadening formation. This is not bullish. This is a bullish trend. This is massive chaos. And if we take a closer look where we ended this week. Here's that little island top right above this broadening formation. This week, resistance into it, bearish engulfing candle right there at that trend line. Is that coincidence? Small caps, this is a weekly chart. This is the bull market trend. Break below it, very briefly trades above it. This is where the S&P island top is and the Dow island top. And here we are again this week. And then we have the NASDAQ, which has made a new high, big rising wedge. I brought this up for members. I think I did this in a video a couple weeks back. This same kind of thing happened where people say, well, the NASDAQ made a new high, so it can't be a bear market anymore. Well, back in 2000, at the 2000 top, it was the NASDAQ that was weak. So the NASDAQ broke down, made a counter trend rally, did not make a new high, but the S&P almost did. It was 0.2% off. So they did the same thing that the NASDAQ's doing here. They all turned over into a bear market. It's not without precedence. It's not something that's completely unusual. I did not open any new positions this week. Actually, I did. I bought one thing on the long side. Members, you know what that is. I'm just waiting for a signal to say, well, I think this correction is over. The S&P does have a little bit more of a bullish look to it. And then if you look at the transports, they have more of a bearish flag. And I will wait for the signal. Like I said, I closed one short over here, took a big profit on that. I left 4 open this past week. 3 out of 4 made more money this past week despite the correction. One of those shorts is in a bank, and next week the Fed is going to release a new stress test for the banks. Maybe their loan loss provisions will have to go up. Neil Kashkari from the Minneapolis Fed was speaking this week, and he thought that banks should stop paying dividends and raise capital because he says Americans are struggling to pay their loans and credits. From the Wall Street Journal, over 100 million loans have not been paid since all this started. That's one of the shorts I'm in banking. My target on the downside is still the same. If this is a little bullish flag, then I think we can get a move up to this trend line, maybe a teeny bit above. This is the year-to-date unchanged mark for the S&P 500. Otherwise, the rule of thumb, again, is wedges retrace their base, as we saw over here. And I still lean towards a second leg down. But this first leg, I think, had to be corrected. It was so oversold so quickly and at so many different support levels. It seemed likely we'd see that correction. Did. Ended the week with bearish engulfing candles. Members, if anything comes up on Sunday night, I will put out a brief. Otherwise, you kind of know where I stand, looking for those signals and where I will take some action. For everybody else, thank you for listening. Thank you for watching. If you enjoyed it, please give it a thumbs up. And as always, feel free to leave questions, comments in the question section below. I read them all. I try to answer them all. You can also follow me on Twitter and check out the website. You can sign up for our free posts, or you can check out being a member. With that, happy Father's Day, everybody.